Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're finally going to finish the relic spotter case by putting together its statement of cash flows using the direct and indirect methods. Let's get started. Last time we looked at the relic spotter case, we put all of the cash transactions into operating.
What? Left here, no battery. Fine. Might check. Cool, another day. Let's continue doing the lectures.
Investing and financing buckets. So now we're going to go ahead and use these classifications to put together the cash flow statement. To do the indirect method, we're going to need to pull some information off the income statement. So here's a reminder of what the income statement looked like for Relic Spotter. And we're going to need to use the balance sheet. So here's what the balance sheet looked like for Relic Spotter.
Where did all of the zeros come from? I don't remember all of those zeros when we put together the balance sheet.
Good memory. In fact, when we put together the Relic Spotter balance sheet, we didn't have all these zeros in there because we only put together the ending balance sheet. But when we do a cash flow statement, we need the change in the balances, the difference between the beginning balance and the ending balance. There was no beginning balance in any of these accounts because Relic Spotter is a startup company, so I went ahead and created a beginning balance sheet of all zeros to make it clear that we're taking the change in the balances for the statement of cash flows, not just the ending balance. First, I'm going to do the direct method for investing and financing activities. Once we get that out of the way, then we'll look at operating activities under both the direct and indirect method. For the investing activities, we need to pull out the column of cash flows that we classified as investing, and then just list them in the cash flow from investing activities section. So we have purchase of land for $103,000, purchase of buildings $85,000. We purchased metal detectors of $120,000 cash, and purchased the software, which is a long-term asset, $2,100. Add them all up, we get net cash outflow from investing activities of $310,100. This section will go on the final cash flow statement.
How do you determine which line items to report on the statement? Oftentimes, don't companies simply report a line called capital expenditures?
There are generally no specific rules that govern how much or how little detail you break things into on the statement of cash flows. It's the manager's choice, but usually the manager makes the choice based on what investors and analysts want to see. Because if investors and analysts are looking for a piece of information that's not there, they'll just ask the company about it during a conference call or some other communication. So what you're seeing on the cash flow statement is a joint agreement between managers and the users of the financial statement as to how much detail they want to see in these various line items about the company. Next, we do the direct method for the financing activities. So here is the column of cash transactions that we classified as financing. Now we just need to list them. So we paid dividends of $2,500, proceeds of sale of stock, that was $250,000 coming in, and proceeds from the mortgage payable was $124,000 coming in. That gives us a net cash inflow from financing activities of $371,500, and this section will go on the final cash flow statement. Now, even though it's somewhat theoretical because companies never really report these, we're going to look at the operating activities under the direct method. So let me pull in the operating cash flow transactions, and under the direct method, all we have to do is list them. So first, I'm going to take all the cash that we collected from customers. We received cash on the rental prepayment from the Penn Antiquities Club, the revenues that came in cash from metal detector rentals, and then the $35,000 of cash from the sundry sales. You add that together, and we have cash collected from customers totaling $156,300.
Wait, we haven't recognized revenue yet on the rental prepayment amount. How can we justify putting that on the cash flow statement?
Well, we can justify putting it on the cash flow statement because Relic Spotter actually received cash. But you raise a good point in that a lot of the examples we've seen so far, companies are recording revenue before they receive the cash, and so we have a change in accounts receivable. But you could have a company receive the cash before they earn the revenue. The cash flow statement is just giving you cash in and cash out during the period, and that's going to be different from revenue, but it could be different in either direction. Either you might get the cash first, or you might get the cash later compared to when you book the revenue. Continuing on, we paid $2,000 cash to our supplier, and we bought an additional $38,000 of inventory with cash. Add that up, cash paid to suppliers is $40,000. Cash paid to employees for salaries and wages was $82,000. Cash paid for short-term loans was $5,000. And then I'll combine legal fees and advertising into cash paid for miscellaneous expenses of $11,900. Again, whether you list those separately or combine them depends on what your financial statement users want to see in terms of the level of detail. We add all this up and we get net cash from operations of $17,400, which is what we had in the operating bucket to begin with.
Okay. This direct method is simple, clear, straightforward, and informative. But you said that companies rarely use it. So,
why do we have to learn the indirect method? Why do companies prefer the indirect method? And why does the Fasb require it even when the direct method is chosen?
yes, that is what I was going to ask. Let's hear your answer.
I'm glad you asked that question here because this is the best place for me to show you why the direct method is not that useful for the operating section of the cash flow statement. Let me jump out to the slide to show you what I mean. So Relic Spotter's cash collected from customers was $156,300. Is that good or bad? Relic Spotter's cash paid to suppliers was $40,000. Is that good or bad? Well, you can't tell without some kind of benchmark. You could look at prior year numbers to see if there's a trend, but what we really want to know is what was the level of activity surrounding these cash collections during the year. For example, if Relic Spotter had $157,000 of revenue and collected $156,300 in cash, then the cash flow makes sense. But if Relic Spotter had $500,000 in revenue but only collected $156,300, then there may be a problem. Or let's say that Relic Spotter sold $40,000 of inventory, paid $40,000 to their suppliers. Again, the cash flow makes sense. But what if Relic Spotter only sold $10,000 of inventory? Then the question is, why did they spend an extra $30,000 in cash to acquire inventory they didn't sell? What the indirect method is going to do is start with net income as a benchmark for the expected level of activity or expected level of cash flows during the period, and then highlight any discrepancies from that level. This is the kind of thing we'll talk about when we do an analysis of an indirect cash flow statement after we finally put one together later in the video. Now we're going to do the indirect method, which will be what we'll show on the final cash flow statement for Relic Spotter. We're going to go step by step following the algorithm that I did before, starting with net income. So I pulled up the income statement. At the bottom line, we can see net income was $2,370. So on our indirect method cash flow statement, we start at the top with net income of $2,370. Notice I already have the answer at the bottom, net cash from operations of $17,400, because whatever we do in this section, we have to get the same answer that we got under the direct method. Okay, so far so good. Next step in our algorithm was to adjust for components of net income tied to non-cash items or investing activities. We could ignore investing activities for Relic Spotter because they didn't have any gains or losses on sale of PPE or investments. So it really involves adding back the depreciation and amortization. Here is the income statement again. We had metal detector depreciation of $3,000, software amortization expense of $350, and building depreciation expense of $1,500. I'm going to combine those into one line item called depreciation and amortization of $31,850, and we're going to add that back to remove that non-cash expense from net income.
Do we always combine all of the depreciation and amortization into one line?
Again, this is a choice by managers about how much or how little detail they want to provide on their statements. One thing I will say here is that generally the only place you can find depreciation and amortization expense in the statements is on the statement of cash flows. Yes, it's part of the income statement, but it's often combined with other items and not broken out separately. But you'll always be able to find it broken out separately in the operating section of the statement of cash flows. The last step in our algorithm is to go through all of the asset and liability accounts related to operating activities, in other words, the working capital accounts, and add or subtract the change in the balance based on the balance sheet equation. So start with accounts receivable. Accounts receivable went from 0 to $4,200, so it went up by $4,200 during the year. That's a non-cash asset going up, which means we need to subtract it on the cash flow statement to stay in balance. Notes receivable went from 0 to $5,000, non-cash asset going up. To stay in balance, we need to subtract that in the cash flow statement, so we subtract change in notes receivable of $5,000. Interest receivable went from 0 to $250, non-cash asset going up, so we subtract it on the cash flow statement. Inventory went from 0 to $12,000, non-cash asset going up, so we subtract it on the cash flow statement. Prepaid advertising went from 0 to $4,000, and again, non-cash asset going up, we subtract that on the cash flow statement.
I think I understand. Assets are always subtracted when the indirect method is used.
No. That's just a function of looking at a startup company, which of course had a balance of 0 in all the assets at the beginning of the year, and so all the assets went up. In a future video, we'll look at examples where companies do add assets to their statement of cash flows because they've had assets go down during the year. If we look at the rest of the asset side of the balance sheet, we have land, buildings, metal detectors, software. We don't do anything with those in the operating section because we've already taken care of those in the investing activities. So we move on to the liability side of the balance sheet. We have accounts payable went from 0 to $2,000. That's an increase in a liability of $2,000. Note we're on the other side of the equal sign with the liability. So liability going up means that we need to add it to the cash flow statement. Interest payable went from 0 to $4,900. So that's an increase in a liability of $4,900, which we need to add to the cash flow statement to keep the balance sheet equation in balance. Income taxes payable went from 0 to $630. again, an increase in a liability, gets added to the cash flow statement. And unearned revenue went from 0 to 1,100. That's an increase in liability that gets added to the cash flow statement.
And I think I am not wrong to assume that it is not necessarily the case that liabilities are always added under the indirect method.
Wow, there were a lot of negatives there. I'm not really sure what the question was. But you should not assume that liabilities are always added on the cash flow statement. Again, because we were looking at a startup, all the liabilities went up in value, and so we added them. We will see examples where liabilities go down during the year, and we end up subtracting them on the cash flow statement.
Going back to the balance sheet, the next accounts we would have would be mortgage payable, common stock, additional paid in capital, but we already took care of those with the cash flow from financing activities. And retained earnings, that's just net income and dividends, which we've also taken care of, so looks like we're done, which is a good thing because we're out of space on the indirect method cash flow statement here on the right. And if you add everything up, you'll find that we get the same answer, $17,400, that we got under the direct method. So putting it all together, this is what Relic Spotter's cash flow statement is going to look like. Cash flows from operating activities are going to be under the indirect method, and then we'll have cash flow from investing and financing activity under the direct method. In terms of analysis, what this statement tells us is that this company is still in the early growth stage of its life cycle. We do have positive cash from operations, $17,400, but that's nowhere near enough to cover all the cash outflow for investing activities. So Relic Spotter had to go out and raise a lot of cash through financing activities, both through stock and mortgage payable. So again, just like we did in prior videos, we can look at these three buckets, operating, investing, and financing, to get a sense for where a company is in its growth stage and life cycle. Now I want to focus just on the cash flow from operating activities section so we can talk about what we learned from this indirect method presentation. First thing we learn is it gives us the two different pictures of the company's performance during the year. So we see Relic Spotter's net income, which answers the question, did Relic Spotter price their rentals and sales high enough to cover all the costs of running the business and thus post a profit? And we can see they did. They had a profit of $23.70. Then at the bottom, we see net cash from operations, which answers the question, did Relic Spotter have more cash coming in than cash going out in activities related to running the business? And here we see that that was the case also. Between those two pictures of the business, we see all the discrepancies, all the reason why we got different answers. And the biggest discrepancy is the depreciation and amortization. And that makes sense because net income includes an expense or a charge for using up these fixed assets, using the buildings and metal detector and softwares, whereas there is no cash implications of doing that, and so it doesn't affect cash from operations. So anytime you look at companies that are very capital intensive, they have a lot of long-term assets, you'll see this difference between net income and cash from operations is primarily driven by this depreciation and amortization. Then we have all of the changes in working capital that have created discrepancies between net income and cash flow. And from an analysis point of view, I think these are the most interesting and important lines to focus on in the cash flow statement. Because what these lines are telling you is that some management activity is creating a wedge between cash flows and revenue and expense recognition. So what you want to do is focus on the really big numbers and try to understand what's going on. So for instance, the biggest number is the change in inventory is a negative $12,000. What that represents is that Relic Spotter purchased $12,000 more inventory in cash than they needed for their level of sales, which were recognized in net income. What you want to do now is dig in and try to find out what caused that. So did Relic Spotter management buy a bunch of inventory that they couldn't sell because nobody wanted it? Then this would be bad news. Or were they getting some kind of volume discounts, and so they were buying excess inventory in advance of future sales, which would be good news. I mean, the cash flow statement's not going to tell you which one it is, but it's going to tell you need to dig into these further. As another example, a big discrepancy that you often see is changes in accounts receivable, which in case of Relic Spotter was negative $4,200. This indicates that they booked more sales than they collected cash. This could be good news if their sales are growing dramatically and they just haven't had a chance to collect them yet. Or it could be bad news if their sales on account to customers are not getting collected because the customers are not paying, they're in financial difficulty. Again, we don't know which scenario is going on just by looking at the cash flow statement. What it does is it highlights we need to dig into these further. So you want to look for the big numbers in these changes in working capital, and these are going to be a starting point for further information gathering to try to figure out what's going on at the company.
So that was our first trip through putting together an indirect method cash flow statement using the balance sheet and the income statement. Not clear yet? Don't worry. There are more examples coming in the future videos. I'll see you then.
See you next video.
Ebitda.
Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to tackle a number of miscellaneous cash flow topics that I haven't gotten to yet. First, we'll talk about how to treat a gain or loss on sale of property, plant, and equipment on the cash flow statement. Then we'll talk about some complications in how things are classified on the statement of cash flows. And we'll wrap up with a discussion of earnings versus cash flow versus Ebitda versus free cash flows. It's a big agenda, so let's get to it.
First, let's look at an example of how to treat a gain on sale of property, plant, and equipment under the indirect method cash flow statement. So let's say we sold property, plant, and equipment worth $70 on the books for $75 cash.
Forgot was COGS, cost of goods sold.
How are we able to sell PP&E for more than it is worth? I bet that never ever happens in the real world.
You're correct that we can't really sell something for more than it's worth because what somebody pays for it is essentially what the asset is worth. But I said how much it's worth on the books or the financial statements. And remember, the book value of property, plant, and equipment is going to be a function of our depreciation assumptions because it equals the original cost minus the accumulated depreciation. So if the depreciation assumptions are incorrect, which they always are, then we're going to end up selling it for more or less than it's on the books. So think of it this way. If we depreciate something too much, we drop its value too much, we end up having a gain on sale, which sort of brings it to the true amount of depreciation over the life of the asset. If we depreciate something too little, then we'll have a loss on sale, which again gets us to the true level of depreciation on the asset over its life. So this gain or loss on sale helps us adjust our incorrect assumptions and get the true amount of economic depreciation over the life of the asset.
Anyway, that's going to result in a gain of $5, which will go on the income statement.
Excuse me, does this $5 gain count as revenue?
Excellent question. Although this gain will go on the income statement and increase net income just like revenue would, we're not going to consider it top-line revenue because it's not part of our core business activities. In other words, we're not in the business of buying and selling buildings. One implication of this example is because it's not a core business activity, it's going to be an investing activity. And because it's an investing activity, we need to remove that gain out of the operating section and place it into the investing section.
So we're going to consider all $75 of cash that we receive as an investing activity, which is another indication that we don't treat this as a revenue activity because if it was, it would be part of operating cash flow. So I'm going to bring back one of the basic examples we did early on, where we have all of our sales in cash, all of our cost of goods sold in cash, and then depreciation of $10. We're going to add to that the gain on sale of property, plant, and equipment, which goes on the income statement, which would make our net income $35. Under the direct method cash flow, all of our sales were cash, so we have collections from customers of $100. All of our cost of goods sold was in cash, so we have payments to suppliers of $60. Depreciation, of course, is not cash. And the gain on sale of property, plant, and equipment, we want to consider that part of the investing cash flow. So we ignore that, and we end up with operating cash flow of $40. And then we have investing cash flow as the full $75 proceeds from sale of PP&E. Under the indirect method, we start with net income, which is $35. We add back depreciation expense of $10 because it's a non-cash expense. And then we have to remove the gain, otherwise we'll double count that cash flow. A gain increases net income, so to remove it, we need to subtract the gain. Once we do that, we end up with operating cash flow of $40, so it's the same under the indirect and direct method. And then we have, again, the full cash flow from the sale of the PP&E, $75, as an investing cash flow.
I believe that some students could be confused by this example. Could you provide the viewers a handy algorithm for remembering how to adjust for such gains?
I do have a little memory device that I use when I teach this on campus, but I'm trying to think about whether I'm too embarrassed to put this on video. What the heck, let's do it. So the way to remember how to deal with gains and losses on investing activities in the operating section is the hokey pokey. I don't know if you remember this little song and dance, but it goes something like this. You put the gain in, you take the gain out, you put the gain in and you shake it all about. You do the hokey pokey and you turn yourself around. That's what it's all about.
Next, I want to talk about some of the complications that you may run into when looking at a statement of cash flows. These are not things that we're going to explicitly cover in the course, but I want you to be aware of them because you will run into them in practice. And all these complications surround the question, why doesn't the change in the balance sheet numbers often equal the number on the statement of cash flows? So in all the examples that we've done so far, when you look at the change in the balance sheet numbers for, say, accounts receivable, it's the exact same number that you see in the operating section on the statement of cash flows. But in real financial statements, you often see it's not the case for one of these four reasons. First, there could be non-cash investing and financing activities that relate to the working capital accounts in the operating section. An example would be, let's say one of our customers who owes us an account receivable can't pay us cash, so instead they give us a piece of land. Well, that would be a non-cash transaction. It would be disclosed at the bottom of the statement of cash flows. It would also affect the balance sheet number for accounts receivable, but it wouldn't show up on the cash flow statement because there's no cash involved. A more common example would be acquisitions or divestitures of businesses.
You can do
All the
so
cash
many
that
shitty
companies
stuff
pay when they
there.
acquire another company is considered an investing cash flow. But part of the things that companies acquire are working capital assets and liabilities. So for instance, let's say a company made an acquisition. Part of the acquisition, they acquired some accounts receivable. Those accounts receivable would show up on the balance sheet, but would not be part of the number in the operating section because we want to call that cash flow an investing cash flow, and we don't want to double count it, so we break it out. Third, there are foreign currency translation adjustments. For multinational companies, which have subsidiaries in multiple countries in different currencies, what we do is we take any effect of exchange rate movements and break them out of the operating section of the cash flow, showing them at the bottom. So a foreign exchange rate movement would affect the balance of, say, accounts receivable or inventory in the balance sheet, but we wouldn't show it in the operating section of the statement of cash flows.
Foreign currency, what's... Does anyone even do these in the real world?
Do you mean the MTV show The Real World, or in practice? Because you're talking about the MTV show The Real World, I don't think they did any foreign currency translation adjustments. It seems more like a Jersey Shore thing. Anyway, this is a pretty advanced topic. It's something I cover in a second-year elective, so we're not going to go into this in detail in this course. I just wanted you to be aware of the fact that all of the effects of exchange rate movements on the cash flow statement are broken out on one line item in the bottom, so that when you look at the operating section, what you're seeing are changes in accounts due to real activities, not due to exchange rate movements.
The last complication is that sometimes companies have subsidiaries in different industries which affect what is considered operating versus investing activities. So let's think back to our company before that made the pills to cure gray hair. Not that gray hair needs to be cured. Let's say this company goes out and buys a real estate subsidiary. What would happen then is the pharmaceutical company buys land, it would be considered an investing activity. But if the real estate subsidiary buys land, it would be considered an operating activity because that's part of their core operations. So the same transaction of buying land could show up as either operating or investing. Now, companies in this situation will sometimes produce separate cash flow statements to help investors see these different activities match up in the different subsidiaries. Next, I want to talk about disagreements that analysts and investors have over the Fasb classification of a couple items. I know it's hard to believe that people would disagree with the Fasb, but there are a couple disagreements out there. The first, many investors and analysts prefer to classify interest payments as a financing activity and interest and dividends received on an investment as an investing activity. Under IFRS, a company could put those activities in the different buckets, but remember under US GAAP, you're required to call those operating. So one thing the Fasb did is they required a disclosure of cash paid for interest, so if investors or analysts want to take it out of operating, they can easily subtract it because that disclosure is provided. Another disagreement is that all income tax effects are shown in the operating section, even if the income relates to financing or investing activities. So if there's an income tax effect from getting, say, a gain on selling property, plant, and equipment, which would be an investing activity, the tax effects show up as operating. So the Fasb requires that all cash taxes paid must be disclosed. Again, so if you don't think that cash taxes should be part of operating, you can take them all out in your calculation. Next, I want to talk about this measure Ebitda, which is defined as earnings before interest, taxes, depreciation, and amortization. Ebitda is often used by investors and analysts as a proxy for operating cash flow.
Basically.
And because it excludes interest and taxes, it solves for that problem that we talked about on the last slide. However, Ebitda does not do a good job of measuring cash flow if there are large changes in working capital like accounts receivable or inventory. And in fact, it suffers from the same manipulation potential as net income. So for example, let's think of a company that does channel stuffing. Channel stuffing is a situation where at the end of a quarter, the company is trying to meet an earnings target, so they ship a bunch of product to customers in order to book the revenue, which would then increase earnings, and of course then increase Ebitda. But there's no cash that's collected, the customers haven't paid us yet, instead accounts receivable go up. So Ebitda would consider this channel stuffing as a cash flow, but it's not a cash flow. Now if we took Ebitda and adjusted for this increase in accounts receivable, then we would have a good measure of cash flow. And I'm going to talk about this more in the next video.
I believe this is not correct. Everyone knows that EBITDA is the best measure of cash.
No, I feel pretty strongly that Ebitda is not a good measure of cash flow, because unless you adjust for these changes in working capital, then Ebitda is just as easy to manipulate as earnings is. What we're going to do in the next video is a case where we'll highlight some of these drawbacks of Ebitda, and I'll show you when it's not a great measure of cash flow.
And then one more point on this. You often hear people talking about cash is king, implying that you should only look at cash from operations or Ebitda as a proxy for cash from operations, and not even look at earnings because it's too easy to manipulate. Well, there's actually been a lot of academic research that's looked at this question of earnings versus cash flow, and it finds that earnings are a better predictor of future cash flows than current cash flow from operations. The reason is that earnings is trying to measure the creation of value. It's trying to answer the question, are you able to price your product or service high enough to cover all the costs of doing business? If so, you tend to get high cash flows in the future, even if it turns out you don't happen to have high cash flows this period. Whereas cash from operations can be much more susceptible to timing effects, which is something we'll look at in the next video. But the good news is you don't have to choose one or the other. You get both earnings and cash flow from operations, and academic research is very clear that if you put both measures in together, you get the best predictions of how a company is going to do in the future in terms of its future cash flows.
I bet that accounting professors did the research to show that earnings is better than cash flow. Is that really the case in the real world?
Yes, it was mostly accounting researchers that did this research, but is there anything wrong with that? The data that they looked at, though, came from real companies, looking at long time series of data from 1962 to the present, and it's a very robust result that earnings are a better predictor of future cash flows than current cash flows. But again, the research emphasizes that best prediction comes from including both measures together.
The last topic of this video is that I want to briefly talk about free cash flow. Now, this is more of a finance topic where they use free cash flow a lot, but since we've been talking about cash flows and these finance approaches generally pull cash flow numbers out of the financial statements, I wanted to briefly give you some cautions that you should have in dealing with free cash flows. When people talk about free cash flow, they generally mean operating cash flow minus cash used for long-term investments. There's valuation models out there that show if you forecast out a company's free cash flows, discount them back to present value, you'll get a measure of how much the company should be worth, what its stock price should be. The problem is that if you look across these measures of free cash flow, there's often no standard measure for operating cash flow. So I've got a number of accounting and finance textbooks lying around my office, and they all seem to define operating cash flows differently. One book defines it as cash from operations before interest expense, so using the Fasb number and then adjusting for interest expense. Another defines it as NOPLAT, which is net operating profits less adjusted taxes, which would be Ebitda minus cash taxes on Ebitda, which is not a good measure of cash flow because it doesn't measure cash. Without changes in working capital, you won't get a measure of cash. The next one, NOPAT minus increases in working capital, is a better measure. NOPAT is net income adding back interest expense and then adjusting for changes in working capital to get closer to cash flow. Another book called it net income adjusted for depreciation and other non-cash items minus an increase in working capital, which I guess would be okay as long as the depreciation was after tax because net income is after tax. Another said gross up earnings before interest and taxes and add depreciation, and a lot of them just say Ebitda without defining what it is. And on top of this, another problem you'll encounter is companies will often disclose free cash flows using their own custom definition. And what you'll find is that definition often changes across companies, or companies will change it across years. So if you're using any kind of cash flow measure, the most important thing is to figure out how it's actually defined, because some of these measures are defined much better than others.
I believe a better approach than telling us everyone is wrong would be telling us what is correct.
I'm not saying everyone is wrong. I'm just saying some people are more correct than others. I think there's two approaches that would give you a really good cash flow from operations number. The first approach would be to take the cash from operations from the cash flow statement, which uses the Fasb classification, and then subtract out cash paid for interest and cash paid for taxes, which are disclosed somewhere else in the report. The second way would be to start with Ebitda and then adjust for these changes in working capital like receivables, inventories, and payables using the balance sheet equation like we do under the indirect method. In the next video, we'll look at a case which will better highlight some of these advantages and disadvantages of these different measures for cash from operations. So I know that was a lot to throw at you in one video. What we're going to do in the next video is look at a couple examples which will give us more practice on putting together cash flow statements under the indirect method. It'll give us some practice on handling gains and losses on sale of property, plant, and equipment in the cash flow statement, and it will allow us to continue our discussion of earnings versus cash flow versus Ebitda. I'll see you then.
I believe that we will see you next video.
Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to look at a couple of made-up companies, Purple and Green, which have very different net incomes, but exactly the same cash flow. It will give us some more practice at putting together cash flow statements under the indirect method, but more importantly, it'll allow us to talk more about the differences between net income and cash flow, and it'll give us some practice in doing a complete analysis of a statement of cash flows. Let's get started.
To put together cash flow statements for Purple Incorporated and Green Company, we of course have to start with net income. So here are the income statements for both Purple and Green. We can see that Purple has $150,000 of net income, Green has $50,000. So when we start on the statement of cash flows, that's going to be the top line, the net income for Purple and the net income for Green. Now the next step in putting together the cash flow statements for these two companies would be to look for non-cash charges like depreciation. If we go back to the income statement, you don't see depreciation anywhere here. That's because it's lumped in with cost of goods sold. So what I'm going to do is give you some additional information that you'll need to solve this problem. And the first piece of it, so Purple had $50,000 of depreciation included in cost of goods sold. Green had $100,000 of depreciation included in cost of goods sold. Under the indirect method, we add those two back. They're non-cash expenses, so to remove them, we have to add them back. Now, there's actually another non-cash expense for at least one of these companies, and that's an expense due to restructuring. So Purple had no restructuring activity in 2012. Green recognized a $75,000 liability due to restructuring in 2012, but did not pay any cash on that liability during the year.
Excuse me, what is this restructuring liability? Why is an expense recognized before any cash is paid?
This is the Conservatism Principle in action. So we talked about this in prior videos, but the Conservatism Principle says that when a company anticipates future losses, they have to recognize an expense for them today. So in this case, Green has decided to restructure. They have a restructuring plan which will involve laying off employees, incurring employee severance costs, closing facilities and incurring facility closing costs, and they have to recognize an expense for the total amount of those estimated cash costs today, and then create a liability that will represent the obligation to pay those cash costs in the future.
To reinforce this point, let's take a look at the journal entry Green would make when they record this restructuring liability. They debit restructuring expense for $75,000. That represents the amount of expected future cash flows they're going to spend on the restructuring, which they're required to recognize an expense in the year they make the decision to restructure. They credit the restructuring liability for $75,000, which of course is the obligation to pay that cash in the future. Notice there's no debit or credit to cash here, so this is a transaction that has no cash impact. So we treat the restructuring charge like depreciation. It's a non-cash expense, so to remove the non-cash expense, we add it back to get from net income to cash from operations. Next, both companies had proceeds from selling equipment during 2012. Purple sold equipment for $30,000, which included a $10,000 gain over the book value of the equipment. Green sold equipment for $50,000, which included a $20,000 loss over the book value of the equipment. Now I'm going to show you the journal entries here just to make clear how this works. We're going to revisit this topic later in the course. So what Purple would have done is debit cash for $30,000 because that's how much cash they're receiving. They have a gain on the sale, which is a credit. It's like a revenue. It increases net income. It increases stockholders' equity. So you credit gain on sale for $10,000. And then they would credit net property, plant, and equipment to take the PP&E off the books at its current book value.
What is a net PP&E account? Do they even have these in the real world?
No, they don't have net PP&E accounts in the real world. I'm just using this as a simplification for now. In the real journal entry, what you have to do is credit the building account for the original cost of the building and debit the accumulated depreciation account for all the depreciation that's accumulated so far in the building. We'll see that journal entry in a couple weeks, but for now I'm trying to keep things simple, so I created a net PP&E account. Sorry.
Now let's look at the journal entry for Green. They would debit cash for $50,000 because they're receiving $50,000 cash. They debit loss on sale. The loss is just like an expense. It reduces net income, reduces stockholders' equity. So that leaves us with a credit to net property, plant, and equipment. The original book value of the equipment that was sold was $70,000. We only got $50,000 cash, which is why we got a loss of $20,000. Now going to the statement of cash flows, what we want to do is take those two debits to cash, the $30,000 and the $50,000, and show them under investing activities as proceeds from sale of equipment. But then to avoid double counting, we need to remove the gains and losses from the operating section. So for Purple, they had a gain of $10,000. We subtract that gain to remove it from net income to get to cash from operations. For Green, they had a loss. We need to add that loss back to remove it from net income to get to cash from operations. By taking out the gains and the losses, we avoid double counting the cash flow in operating. We've already recognized that cash flow in investing.
I believe the viewers would be more entertained right now if you did the okey-pokey again.
Ugh, I suppose. Here it goes. For purple, you put the gain in, you take the gain out, you put the gain in, and you shake it all about. You do the hokey pokey and you turn yourself around. That's what it's all about. Now for green, you put the loss in, you take the loss out, you put the loss in, and you shake it all about. You do the hokey pokey and you turn yourself around. That's what it's all about.
Next item, both purple and green spent cash flow on capital expenditures, buying things like property, plant, and equipment. Purple had $220,000 of CapEx, green had $70,000 of CapEx. So we know that CapEx is an investing, or is it CapEx are an investing activities? CapEx is or CapEx are?
You Americans have no idea how to use the correct verb tense. You say England is eliminated from the World Cup, when everyone knows the correct version is England are eliminated from the World Cup. Please move on.
Okay.
Anyway, we put a line in the cash from investing activity section where we show the capital expenditures for both purple and green. Next, we have a number of financing activities that two companies did during 2012. Purple received $50,000 proceeds from issuing long-term debt. They made $35,000 of payments on their long-term debt, and they didn't pay any dividends. Green did not issue any new debt. They paid back $95,000 of their existing long-term debt, and they paid $60,000 of dividends to their shareholders. These are all financing activities, so in the statement of cash flows, we just put a line item for each activity to show the proceeds and payment of long-term debt and the dividends paid for the two companies. So now we're done with the investing and financing sections of the statement of cash flow, so we're going to go back and work on the rest of the operating section. I'll give you the changes in the working capital accounts, and we'll go ahead and put those in the cash flow statement. So for accounts receivable, purple had an increase of $100,000 during 2012, whereas green had a decrease in accounts receivable of $100,000. So to know whether to add or subtract these, we need to use the balance sheet equation. Cash plus NCA equals liabilities plus stockholders' equity.
Excuse me, what is NCA?
Sorry, NCA stands for non-cash assets.
Starting with purple, their accounts receivable went up, so that's an increase in a non-cash asset, which means we have to subtract it on the cash flow statement. The intuition here is that they made more credit sales than they had cash collections, so they're booked some revenue that was non-cash, and we have to subtract out the increase in accounts receivable as the non-cash portion. For green, their accounts receivable went down by $100,000. It's a non-cash asset going down, so we add that back on the cash flow statement. The intuition here is that their cash collections were greater than their new sales, which must mean that they were collecting based on prior sales in addition to whatever they collected this period. Next, purple had an increase in inventory of $50,000. Green had a decrease in inventory of $50,000. So starting with purple, inventory goes up, non-cash asset goes up. We subtract that on the cash flow statement. What must have happened here is purple bought more inventory than they sold, with the amount of inventory they sold represented in net income. For green, their inventory went down, so that's a non-cash asset going down. We add that back on the cash flow statement to stay in balance. And what this means is that green actually sold more inventory than they purchased. So not only did they sell whatever they had this year, but they tapped into the inventory at the beginning of the year and sold some of that as well. So that's an extra source of cash flow by selling the inventory from the prior period. Purple had prepaid expenses, which decreased by $100,000. Green's prepaid expenses increased by $25,000 during 2012. So for purple, prepaid expenses go down and non-cash asset goes down. We add that on the cash flow statement. For green, non-cash asset goes up by 25 as prepaid expenses increase. We subtract that on the cash flow statement. For accounts payable, purple had an increase of $75,000 in 2012. Green had a decrease of $75,000 in 2012. Now we're on the other side of the equal sign. So for purple, accounts payable goes up. That means liability goes up by $75,000. So we have to add that to the cash flow statement to stay in balance. Intuition here is that if your accounts payable are going up, that's money that you're not paying to your suppliers, which is a source of cash. For green, their accounts payable went down, their liabilities went down, and so we have to subtract that on the cash flow statement to stay in balance. What happened here is green actually paid more cash to their suppliers than they acquired new inventory on account, and that actually makes sense because we actually saw their inventory reduce, so those two often go together. Inventory as a source of cash is often accompanied by accounts receivable as a use of cash, as you're paying off more creditors than you're adding in new accounts payable. Finally, for interest payable, purple had an increase of $10,000 in 2012. Green had a decrease of $70,000 in 2012. So for purple, we have an increase in interest payables and increase in liabilities, so we add that to the cash flow statement. For green, we had liabilities go down by $70,000 as interest payable dropped. We subtract that on the cash flow statement. And once all is said and done and we add everything up, it turns out that purple and green have exactly the same cash from operations of $225,000.
So these companies have the same cash flow, but purple has 3 times the earnings as green. What do we make of this? Does this happen in the real world?
Yes, in fact, I think it happened in episode 4 of the Real World Honolulu, but maybe I'm not remembering that correctly. Anyway, I'm going to go through now and do a detailed analysis, and we'll talk about why these two numbers can be so different.
Now that we put them together, let's take a look at these two cash flow statements in detail to see what we can learn by analyzing them. First, for Purple, we see a nice big cash from operations of $220,000, most of which they're reinvesting in long-term assets. We see they have capital expenditures of $220,000. Their net cash from financing is slightly positive because for some reason they decided to run up their cash balance by $50,000. But this profile overall looks sort of like a growth, maybe into a mature stage where you've got healthy cash from operations, but most of it is being reinvested back into the business through cash for investing activities. Now let's take a look at Green. Green had the same high cash from operations of $225,000, but they're investing almost nothing in long-term assets. Their capital expenditures were only $70,000, and they sold $50,000 worth of equipment during the year. So what are they doing with all that cash that they're not investing? They're actually paying off financing and paying dividends. So we see a big negative cash from financing activities. They're not borrowing anything new. They're paying off a lot of long-term debt, and they're paying dividends to their shareholders. This is typical of a late mature and decline stage company where the investments aren't there, so they're taking the excess cash flow and paying off debt and returning it to shareholders through dividends. Next, I want to take a look at the operating sections in more detail for these two companies. Starting on the top line, we have net income, and we see that Purple has 3 times as much net income as Green, even though their cash from operations are the same. So is Purple 3 times better than Green, or are they the same company? Well, we can learn what's going on with this discrepancy by looking at everything between net income and cash from operations, so all the things that cause them to be different. The first big difference is depreciation. Green has much more depreciation than Purple. Now, one way that we can try to understand what this means is to compare depreciation and capital expenditures. If you think of depreciation as using up old equipment, whereas capital expenditures is buying new equipment, it's an interesting comparison to look at the relative magnitudes. So for Purple, they have $50,000 of depreciation, but $220,000 of CapEx, indicating that they're growing dramatically. They're investing a lot more in new equipment than they're using up old equipment. When we look at Green, we see $100,000 of depreciation and only $70,000 of CapEx. So Green is not even investing enough to replace its existing use of equipment. So that would indicate that Green does not have a lot of good growth prospects. The next big discrepancy is the restructuring charge, which Green ended up taking during the year. That's a non-cash charge, so it caused net income to go down, but did not affect cash from operations. And in fact, it's one of the big reasons why Green had much less net income. But it's also an indication of bad news, because the restructuring charge is an estimate of all of the future cash flows that Green will have to pay to lay off employees, pay employee severances, close facilities, and things like that. So what net income does is they pull all those future charges into the present with an expense, whereas the cash flow statement will only show those future cash payments as they happen down the road. Finally, we can look at all of the changes in working capital. So for Purple, we see negative effects of change in accounts receivable and inventory, which means those two accounts are growing. Change in accounts payable is positive, which also means it's growing. So this indicates that Purple's business is growing substantially in terms of their working capital. When we look at Green, we see that accounts receivable and inventory was a source of cash because they've been liquidating or reducing their accounts receivable and inventory. Their payables have also been going down. And so this profile is, again, consistent with a company that doesn't have a lot of growth and may actually be reducing its size. So putting it all together, it turns out that these movements in working capital due to all of the changes in working capital. So for Purple, we see negative effects of change in accounts receivable and inventory, which means those two accounts are growing. Change in accounts payable is positive, which also means it's growing. So this indicates that Purple's business is growing substantially in terms of their working capital. When we look at Green, we see that accounts receivable and inventory was a source of cash because they've been liquidating or reducing their accounts receivable and inventory. Their payables have also been going down. And so this profile is, again, consistent with a company that doesn't have a lot of growth and may actually be reducing its size. So putting it all together, it turns out that these movements in working capital due to the different growth stages happen to make the cash from operations the same this period. But Purple looks like it's the much better bet long term because it's throwing off a lot more net income and it doesn't have to do this restructuring down the road. Last, I want to look at Ebitda for these two companies. Remember, Ebitda is earnings before interest, taxes, and depreciation and amortization. And what we see from the Ebitda is that Purple has much higher Ebitda than Green. which means that EBITDA is really not picking up cash flow, because what we just saw in the cash flow statement was that the cash from operations was identical between these two companies. Now, of course, if you think back to the cash flow statement, one of the things that green had was a restructuring charge, which is a non-cash charge like depreciation that needs to get added back. So if we add back the restructuring charge so that we get EBITDA without the restructuring, now the two numbers are closer. Also, if we go back to the cash flow statement, they had different losses and gains on sales of assets. That's part of earnings, but it should be an investing cash flow, so we need to take that out as well. So why don't we adjust for the gains and losses on asset sales, and when we do that, then we get EBITDA that's identical between the two companies. Although, I guess since it's EBITDA without the restructuring and the gains and losses, we should call it EBITDARGLE.
I believe that you simply made up the term EBITDA. Does anyone use that term in the real world?
Excuse me, I am the real world guy. So, does anyone use the term EBITDARGLE in the real world?
I believe we should stop asking you silly questions so you can tell us. What is the best measure of cash flow?
Yes, I did make up the term EBITDARGLE. Probably the only people that use that term in the real world are my former students, and they probably only use it once, get laughed at, and then stop using it again. But I want to raise the point with this EBITDARGLE term that people often say EBITDA, but they don't literally mean earnings before interest, taxes, depreciation, and amortization. Because if there's other non-cash expenses or gains and losses from investing activities, they'll take those out as well and still call it EBITDA. So before you use EBITDA, you got to know what's in the measure.
So one more point I want to make before we wrap up the video. We see that the EBITDARGLE is identical between purple and green, and we saw that the cash from operations was identical on the cash flow statement, but the cash from operations was less than EBITDARGLE. So there's two reasons for this discrepancy. One is that EBITDARGLE takes out interest and taxes, whereas the cash flow statement number includes cash taxes and cash interest. The second discrepancy is that, of course, the net cash from operations adjusts for changes in working capital, whereas EBITDARGLE doesn't. So to get a really good cash from operations number, I would suggest one of the two following approaches. Either calculate EBITDARGLE and then adjust for all the changes in working capital, or take net cash from operations and then add back the cash interest and cash taxes to remove those two. But you have to do one of those two approaches. Taking either EBITDARGLE on its own or net cash from operations on its own is not going to give you the number you want if you're going to take this and put it into a free cash flow model.
I hope that gives you some sense of the things that you can learn by doing an analysis of the statement of cash flows. And I hope it gives you some caution in using this EBITDA measure that everyone seems to like, even though it has a lot of drawbacks. And wow, look at that. We're already done with the week on cash flow statements. Where has the time gone? I'll see you next time.
See you next video.
Cool. Oh, that was a long one. And right here too.